Will the U.S. Treasury default on its debt, and what could that look like? When could it occur? What are the current odds? A lot of questions around the debt ceiling and the U.S. Treasury's potential default. The first, I think, ever in the history of the U.S. Treasury. And I have here in front of you credit default swaps, which are essentially, I view them as a derivatives market that the premium in this derivatives market, the price, similar to if you're looking at options prices, if prices are high, people are seeking insurance of the market that it's underlying, moving a lot. And same here with credit default swaps. If the premium is high, as it is, you can see here, the highest that it's been in many, many years, up at 150 basis points, I believe is the quote there as of yesterday's close. If that premium is high, a lot of people seeking insurance on U.S. Treasuries here, as this is the 1-year U.S. credit default swap. And so the higher those credit default swap prices go, the higher those premiums go, the more unsure the market is, the more people want some insurance, similar to option prices rising as well. And we see this new high as of yesterday. We talked about the potential for default a couple of weeks ago, and we've since then doubled in this credit default swap price from investing.com there. And Yellen recently saying that the deadline for the U.S. Treasury could be as soon as June 1. Now, what does that mean? That means that as soon as June 1st, the Treasury could run out of money to pay Social Security checks, to pay people who own debt, U.S. Treasury bills that are coming due in June. And so the potential for a lot of waves to be made here outside of just this credit default swap, a lot of other markets moving around. And let's get into just the interest rate market and what we've seen here in tandem with fear rising, credit default swap prices rising, short-term yields are rising as well. You can see an unprecedented climb here in the 1-month Treasury bill rate, going from 3.4% 2 weeks ago to now 5.5%, and as close as it's been in years and years and years to 6%. Why is this happening? Well, in the yield market, here looking at U.S. Treasuries 1-month bills, so essentially debt market where the debt is due in 1 month, the interest rate that I would require if I was going to loan out money to the U.S. Treasury would be much higher if there was greater risk. And so the interest rate was down at 1, 2, 3% when it was this idea of the U.S. Treasury is triple A, as good as you can get in terms of someone that you would loan out money to. And now, as the risk gets heightened and heightened of a potential default and the potential for me to maybe not get my money back, at least on time, or if at all, I'm going to require a higher interest rate. And so people selling out of their 1-month bills with the potential of not getting paid on time. And with that lowering of demand, the interest rate that the U.S. Treasury would be paying for you to loan them out money for 1 month coming around the time of this potential default, that interest rate climbing. So a similar type measure of fear. If the debt ceiling talks were concluded, they raised the debt ceiling, no potential of a default 1 month from now in June, then this interest rate would likely come back lower and fall in line with the rest of the yield curve, which is 2, 10, 30 years out in time, all around 3.5% to 4%. And so you can see here, pitted against the rest of the yield curve, there's great short-term risk. And so this tells you a couple of things. One, like I was saying, if the debt ceiling was raised and the potential for default did go back to being near nil, then the 1-month Treasury bill rate would come down to these more normal prices. This is also telling you a second thing, which is this is a short-term risk. The market telling you that anything outside of a few months from now, not really seeing a ton of risk. If there was the potential for a default by the U.S. to last years and years and years, you would see the rest of this yield curve climbing as well. The potential for that default, everybody thinking that, if the Republicans don't back down, essentially giving way to what they've called for recently, which is spending cuts in tandem with the debt ceiling being raised, and the Democrats don't back down from their stance of, we're not going to talk about the spending cuts here, just raise the ceiling, we'll talk about it later. If that standoff continues, we see the default here in June, as Yellen says, but it would be alleviated by, obviously, debt coming due 2 years down the line, 10 years down the line, and what have you. That being said, the default risk here is centered in that 1 month range, but also 3 months and 6 month rates being quite high, and even 1 year rates being quite high as well. If this default does turn long term, and I don't think anyone is necessarily thinking that the U.S. would default for years and years and years, but it goes on for a month, 2 months, 3 months, you would expect the U.S. to be downgraded in its credit rating. I believe it was downgraded from, I don't know, maybe it is still AAA, but I think it has been downgraded in recent years. And another downgrade would likely fall in line with the U.S. having to have their interest rates higher to demand people buying their treasuries at a lower credit rating. Again, the lower the credit rating that you have, usually the higher interest rate that you need to give to the people who are loaning you out money. And so if this default does occur and it becomes more of a long-term problem outside of just 1 month or 2 or 3 months, you would expect that rates are heightened in general. And not only that, but the U.S. would potentially not be paying Social Security, and everybody, a lot of people thinking about, this falling in line with the U.S. paying the tax season that's just gone by, and paying I forget what the term is for it, but paying out to U.S. citizens what they're due from this most recent tax season. A lot of different effects here at play that would potentially, as the more long-term this default could get, the more you could see it play out in the way of unemployment and stock market downside. And that makes sense, right? If there's higher interest rates that must be required for U.S. Treasuries, that benchmark is heightened. That benchmark is going to play out for companies, money being more expensive, and everyday people who want to buy, a house, want to buy a car. The benchmark being raised there for interest rates throughout all different time periods. They're playing out to just a lot of potential downside. Some different analysts from banks looking at a U.S. default of 2 to 3 months, translating to, I saw some quotes of 30 to 40% downside in the stock market. Now, of course, I think that's a doomsday type situation, but it does give you a little bit of color as to how bad this could get, what it could mean as the potential for default could play out in that interest rate market, could play out in companies not having as great access to money in general, having to potentially lay people off, seeing some downside in the stock market because of that, and just everyday people not being able to access money for buying houses. A lot of different effects that all pretty much say negative for the stock market. All of that being said, everybody, I think, is trying to alleviate this potential crisis here on the Republican and Democrat side. Of course, there's going to be a little bit of a standoff as to we want this. But, between Janet Yellen coming out and what she said, Fed Chair Powell, what he has said, how catastrophic this could be for the economy, most likely this does get resolved by June, but you can't help but see whether it's the credit default swap space or the interest rate space, certainly odds of a potential default climbing by the hour.